This chapter is about currency and exchange rates and how those affect international trade. By the end of this chapter, you'd want to understand how exactly the Canadian dollar trades against other currencies and what are the impacts of those exchange rates. What does it mean when the dollar is high, and what does it mean when the dollar is considered low? So, exchange rates are necessary for globalization because we are buying and selling goods to other countries. So, in order to buy and import a product from another country, we need to convert Canadian dollars into that currency. So, if you were to buy something that came from the United States, you would have to convert your Canadian dollars into American dollars to buy the good. Likewise, if a Canadian business were to sell their goods, they would receive money in another currency, and then they deposit it at the bank and put it into their bank account into Canadian dollars. So when we say the exchange rate, we're basically saying what's the value of one currency versus another. And these are some of the factors that will impact the Canadian dollar. The performance of the Canadian economy. When the economy is going well, it means that Canada is producing goods. They are exporting those goods. It means that the natural resources in Canada are going very well, and it's a strong economy. So there's going to be a lot of demand for Canadian dollars to be a part of that strong economy. So when the Canadian economy performs well, the Canadian dollar will also be high. Economic conditions outside of Canada, that's sort of the inverse. So if, for example, things were particularly strong in Europe, people would want the euro and they would sell Canadian dollars to buy euros to get involved with that strong European economy. If the US economy was outperforming Canada, people would sell their Canadian dollars to buy US dollars. They'd want to be a part of that strong strong American economy. So world commodity prices. Canada exports a lot of petroleum, so our dollar is sensitive to the price of petroleum. When the price of oil goes down, less people need Canadian dollars because they're not spending as much for their oil purchase. The total value of their oil purchase is less, so they need less Canadian dollars. If the oil price goes high, then there will be a greater demand for Canadian dollar. We also have some mining products, some lumber, some agricultural commodities that people need Canadian dollars to buy. Interest rate differentials. That means, for example, if another country, let's say Japan, was paying more interest than a Canadian bank, it would be valuable to convert your Canadian dollars into Japanese yen and invest it at that higher rate of return. So if Canadian banks are not paying as much as other countries, people will sell their Canadian dollar. On the other hand, if Canadian banks were paying more, people would buy Canadian dollars to invest them in Canada. And this is mostly based on the Bank of Canada and the overnight rate. Inflation rate differential. So if the inflation rate in Canada is really high, your goods are more and more expensive, your dollar's worth less and less, it's less valuable. But if inflation in Canada is predictable, slow, and steady, that would be an attractive factor. And also, you would want to just compare it to another country. And usually, inflation in Canada is about 2% per year. So it is something that's stable and predictable. And lastly, is just investor confidence and speculation. What do people think will happen in the future? So, do people think Canada's going to have a good year? If so, they'll buy Canadian dollars to sort of speculate that they'll go up in value. If they think Canada might be in for a rough time, they would sell Canadian dollars, just like speculation, just like on the stock. So there are losers when the Canadian dollar is worth a lot. manufacturers that might export their products to other parts of the world, those products are now going to be more expensive than the domestic counterpart. The tourism industry, people will be less likely to come to Canada because their dollars will not go as far when they are in Canada. Canadian retailers, because it is easy to substitute purchasing either online, or if you were near the border, shopping at an American retailer where where your dollar has more purchasing power, and those who work for international businesses because they're getting paid in their local currency. If they're from a Swiss company, they'd be paid in francs, and then they'd have to convert that into Canadian dollars for their own expenses. And if the dollar is worth more, their purchasing power is less. So sometimes one thing an exporter might decide to do is they keep their prices constant, usually in US dollars, and just lower the profit margin until the interest rate lowers. And also, it's generally considered that a low exchange rate hurts more people than it helps. So here we had a high exchange rate. So if we wanted to say who's wins and lose with a low exchange rate, just flip the slides. The winners become the losers, and vice versa. But just generally speaking, the experts feel that when the dollar is low, it hurts more Canadians than when it's high. However, what really is important is just that it is stable and predictable. We don't want crazy changes in prices. So who might be affected by exchange rates? Here is a short video of what happens when the Canadian dollar is low. The most common exchange rate that you will see in association with the Canadian dollar is the US dollar, as it is Canada's biggest trading partner. And it is the biggest economy near to Canada. So you might hear that in the news that, the dollar fell today in trading, the dollar rose in trading. Right now, as of the date of this recording, the exchange rate is 0.74. So 1 Canadian dollar buys 74 US cents, and conversely, 1 US dollar buys $1.35 Canadian. So the Canadian dollar is less valuable relative to the American dollar. And it's been around this rate, around 75 cents, for quite some time. And since it has fluctuated in between, say, 73 to 77 cents, but it's been relatively stable in recent times. If you need currency information, go to Google and just type in the currency you want to exchange into the search bar, and it will show you the current value. So you could do one CAD to USD, or if you were going to buy something online and you wanted to find out how many Canadian dollars you needed, you could say 29.99 USD to CAD, and Google will tell you. That's probably the quickest way to get a accurate and up-to-date exchange rate. So see, you can look on this chart in the past year, it dropped due to COVID, but it had been fairly consistent, no major swings previously. And I guess it dropped during COVID because markets were shutting down, less international trade, people were maybe less likely to buy Canadian goods, but because we're not the biggest economy in the world, we still needed to import products. So we were still importing things more than we were exporting, and that might have been why it went down. I'm not precisely sure, but when you understand exchange rates, you can understand how they move. So recently, consumers had been, in the last few years, let's say, had been buying fewer Canadian exports, largely because oil prices went down enormously and reduced the price of purchasing oil significantly. So the Canadian dollar had fallen a little bit relative to the US dollar. Here is a little bit more of a long-term graph, and you can see it was from a Bank of Canada site, and it's okay that it only goes up into about 2018, because we know by looking at the chart it's about in that range, around 75 cents these days. So initially it was pegged to the gold standard. But by 1973, it was floating exchange rates were introduced and it began to trade. And initially in the 70s, because energy prices were a lot more expensive, the Canadian dollar was worth slightly more. But throughout the 80s, as the US economy was very strong and took off, it dropped. As the US-Canada Free Trade Agreement was signed and it enabled more people to buy Canadian goods in 1988, there was a greater demand. Although throughout the 90s, we began to use more cheaper products. So we would buy exports from another country and import them. So we were selling our Canadian dollars to buy the other currencies that we needed, and things went down a lot. Oil went up again. The Canadian economy rebounded a bit. The Great Recession, it took a bit of a hit. And then again went back up as oil went out, and then there was a lot of a decline because of the price. As the price, we are really based on the price of oil, and as the price of oil went down from its all-time high, as did the Canadian dollar. So you might hear the term purchasing power. It means that how much is a dollar worth? Like, is the purchasing power more or less than another country or than the year before? So right now I would say relative to the United States, the purchasing power of Canadian is lower. It's more expensive to buy American products. If an American product and it was next on a shelf to an identical Canadian one, it would have a higher price because of the exchange rate. And then so you might choose to buy a domestic good instead of an American product. However, on the other hand, the purchasing power of foreign countries is higher right now, and as the dollar is lower, our Canadian-made goods will look more attractive. So they might choose to buy Canadian dollars and in order to buy Canadian exports. So hopefully you see there's a bit two sides of the coin. It's never all good news, never all bad news with exchange rates. It might make us, a low dollar actually makes it easier to export products. So when the dollar goes high, when there's a high dollar, so that might seem like, oh, it's always going to be good news to have a high dollar. That is not always the case, but these people will benefit. People who import products and distribute them. Canadian travelers, their Canadian dollars are worth more abroad. Major league sports teams, because the salaries are paid in US dollars, but the gate money comes in Canadian dollar. The Raptors, the Blue Jays, the Maple Leafs, they will benefit with the high Canadian dollar because they'll be able to buy more goods. And Canadians who shop online, you might notice if you've been shopping online over the years how your purchasing power might rise or fall. In this case, companies that buy raw materials, for example, they might buy some parts from the United States and make them into an appliance in Canada. They would experience higher profit margins when the Canadian dollar is worth more because the raw materials or the parts that they're buying are cheaper when there's a high Canadian dollar.
And welcome back to CBC News Nova Scotia at 6. The Canadian dollar is at its lowest point in 11 years, coming in at 75 cents US. And while that is great news for tourism in Nova Scotia, it's bad news for those who love to shop over the border. The CBC's Angelique Patil has the story.
It's safe to say Kathy Shano and her friends are hardcore shoppers. Every November they drive to the U.S. to do their Christmas shopping.
We've been doing it for years, as far back as in our 20s. I'm in my 40s now. There's a group of 4 of us. We rent a van.
And that van gets stuffed. But this year the trip is canceled because of the low dollar.
This year I think we'll just stay here in Halifax. We're going to rent a hotel and we'll probably do Dartmouth Crossing, Micmac kind of thing, spend the day and then have a nice evening with the girls in a hotel here.
Get in, baby. Lee Rogers and his fiancée Megan are off to Orlando for their honeymoon in November. They're excited to go, but they're factoring in the low loonie.
That's going to take the money out of our pockets, but now it's the excursions and the extra spending money that we want when we get down there, and obviously that's not going to be beneficial to us.
On the flip side, if you're a U.S. tourist visiting Canada, you'll reap the benefits. Atlantic Tourist says the low dollar has more Americans booking.
They probably can save anywhere from 20 to 30% off the cost of their trip. So that can be quite substantial.
Murphy's gift shop on the waterfront now has some of their items listed in American dollars.
They actually love it because they don't want to look at things and have to think of the conversion on their own, and so they think it's really neat that they can come somewhere that's accommodating their own currency.
Once the U.S. travelers do get here and they realize, just how far their money does go, they are spending more money and they're making decisions to actually come here as opposed to travel within the U.S.
Now, as for Kathy Shano and her girlfriends, they're hoping that they can continue their trip to the U.S. next year, keeping their fingers crossed for a better Canadian dollar.
Angelique Patil, CBC News, Halifax.
So another term to know is floating rate, meaning that the exchange rate can move. And these days, currencies all trade on a floating system where it can move up or down any given day depending on what's happening. And it's pretty much like supply and demand. The more demand for a currency, the higher the floating rate. The less demand, the lower the price. So, as a bit of a history, at the end of World War II, in July 1944, to get ready for the end of World War II, they had the Bretton Woods Conference in Connecticut to talk about how the economy would unfold after the end of the war. And it was agreed to fix international exchange rates to the gold standard. And then this lasted until the mid-60s when it collapsed. And then as of March 1973, all major currencies have floated against each other, and you'll see swings of ups and downs. So initially it was thought that once the gold standard, which was pegging a Canadian dollar to the value of gold and keeping it consistent, that would lead to stability, and it would be easy to trade because you would always know what things would be worth. And if floating exchange rates were to happen, it would be chaotic. No one would be able to make trades because they wouldn't know what would be happening. It turns out that the floating exchange rates have not impacted trade. Obviously, trade has skyrocketed. And as a further positive, they can reduce the impact of shocks because it's not the exchange rates will change if an extraordinary economic event happens, and it sort of localizes that extraordinary economic event to the one country that it happened in. And as a result, events tend not to circulate the world, although still an extreme recession like the one brought about by the coronavirus could still do that, but most shocks are absorbed by the floating exchange rates. Revaluation. Increasing the value of a currency because the demand for that particular currency is greater than the supply. So China tried to keep its currency low for a very, very long time. And if you look at a graph, it has a very, very low value relative to the US dollar. They did this so that their exports would be very, very cheap on the world stage, and the people would choose to consume products that were manufactured in China. This was hurting the profit margin of American and European countries, so they pressured China to revalue its currency and raise the value back in 2005. To benefit exporters, a country may want to devalue its currency, and to decrease this is when the currency decreases because the supply of that currency is greater than what the demand is. And so China in 2015 found that its exports were slowing down, so it devalued the yuan so that its exports would appear cheaper on the world stage. So how does China keep its exchange rate relatively fixed? So they export products, and then they're sold, and the companies that sell them have US dollars. Then they have to go and deposit the US dollars in the Bank of China and to pay their employees in yuans, and the Bank of China will hold vast amounts of US dollars so that the supply of the US dollar is artificially lower, and it raises in value, and it raises in proportion becomes more valuable than yuan, so the Chinese exports are less. So the Bank of China would take a more active role in terms of manipulating its currency than the Bank of Canada or the US Federal Treasury would. The book also talks about hard currencies and soft currencies. Hard currencies are ones that are very liquid. They can easily be sold, converted into another currencies. They tend to be stable, not a lot of fluctuations. They tend to represent markets that are big economic players, and there's really no trouble converting them. The US dollar, the Canadian dollar, the British pound, the euro, the Japanese yen, the South Korean won, the Mexican peso, the Swiss franc, the Australian dollar. These are all currencies that are always in demand. They're easily tradable, so they would be known as hard currencies because speculators know that they will hold their value and that they'll be able to sell them at a later time. The opposite of hard currencies are soft currencies. And this is a country that is usually a little smaller, a little weaker, one that might fluctuate often, and it's difficult to convert to other currencies. And this could include the Chinese yuan, the Indian rand, the Russian ruble, the Brazilian real, the Venezuelan bolivar. There's been a lot of inflation in Venezuela. The Zimbabwe dollar, there's been a lot of inflation in Zimbabwe. So these currencies are softer, they're not in demand as much, and it's less likely that you'll be able to easily sell it. Currency speculation would just be a term, just like the stock market, people speculate in currencies. They think, Canada is going to have a good year. I think that oil is going to do well. Let's hold some Canadian dollars so that next year, when it has gone up in value, we'll be able to sell them and get more money in return. And on Forex, foreign exchange markets, over $5.3 trillion are traded daily. So someone who buys and sells and holds foreign currency in order to make a profit when the value changes is a currency speculator. Here are some resources that were used to prepare this presentation.